So in the past week, the Federal Reserve has had their little meeting and decided to keep interest rates exactly where they are until their next meeting. So for those that don't know, the Fed meets 8 times per year to discuss monetary policy, and with interest rates so low, the stock market so high, and inflation creeping up, all eyes have been on Jerome Powell and the Federal Open Market Committee to see what they decide to do from meeting to meeting. It's massive news, and it is always on the front page of CNBC, even if they decide to do absolutely nothing. So in this video, we're going to discuss what happened at this meeting, how bad inflation is getting, and why do investors even care about this stuff. So let's jump in. This video is sponsored by Stake. Download the Stake app today and use the referral code AWC to get a free stock when you fund your account. Details in the description. So yes, the Federal Open Market Committee has had their meeting for the month of June, and at a high level, these were the main takeaways. So number 1, interest rates remain unchanged. 2, the Fed will continue to buy $120 billion worth of assets per month as stimulus. This is broken down into roughly $80 billion in treasuries and $40 billion of mortgage-backed securities. Then number 3, they increased their forecast for inflation this year from 2.4% to 3.4%. And that sounds small, but it's definitely not insignificant. Then number 4, GDP growth is estimated at 7% instead of 6.5%. And the number 5, forecasts for unemployment remain unchanged at 4.5%. So what's the news here? Doesn't sound that remarkable, and honestly, it's not. Everybody expected rates to remain unchanged. Everybody expected the stimulus. The thing that people were really interested in, I guess, is the inflation side of things, because the Federal Reserve holds the tools to control inflation. If inflation rises, they can control it by raising interest rates. But that's obviously not helpful for stock market investors. So ultimately, when it comes to inflation, the ball is in their court. And what's interesting is that the FOMC likes to keep inflation at 2% per year. That's comfortable. This is literally plucked from their website. It says the Federal Open Market Committee, FOMC, judges that inflation of 2% over the longer run, as measured by the annual change in price index for personal consumption expenditures, is most consistent with the Federal Reserve's mandate for maximum employment and price stability. That's kind of their MO, to promote maximum employment and price stability. So the Fed wants 2%, but at their most recent meeting, guess what? They acknowledged that inflation is here, and hey, we thought it was going to be around our target of 2%, but now we think it's going to creep up to 3.4%. That's a fair chunk above what we're comfortable with. I sure as hell hope it doesn't continue like this and get up into the 4% or the 5% range. Now, also along that same line, another thing that's been making big headlines from the meeting is that the Fed has pulled forward their expected time frame for the interest rate hikes. The Fed now expects that they'll be raising interest rates 1 year earlier than what they had previously forecast. They now believe rates will go up in 2023 instead of their previously stated 2024. But in fact, from the meeting, 7 of the 12 Fed officials see a rate increase sometime next year. Now, if we rewind the clock back just to last quarter, only 4 of them thought that that would be necessary. So the signs are there that the Fed is acknowledging that, yep, inflation is getting worse and they see it. But even though that's all on the table now, Jerome Powell still continues to downplay inflation. But honestly, it's for a good reason, because he really just doesn't want to freak people out, because he knows how many people are listening to what he says. Even just his tone of voice is going to have an impact. And at the end of the day, a lot of funds with big money will be making investment decisions based on what he says and how he says it. So that's why, for that reason, this time around, in reference to inflation, he said, you can think of this meeting that we had as the talking about meeting. And what that means, as CNBC notes, Powell said in a phrase that recalled a statement he made a year ago that the Fed wasn't thinking about raising rates. And from the same article here, it says, though the Fed raised its headline inflation expectation to 3.4%, a full percentage point higher than the March projection, the post-meeting statement continued to say that inflationary pressures are transitory. The raised expectations come amid the biggest rise in consumer prices in about 13 years. So what's that about? Well, I delved into the inflation statistics and this article is bang on. So remember, inflation is measured by the Consumer Price Index, which tracks the price changes in many categories of consumer products, and then it simplifies it all into one index. For example, it includes things like food, housing, apparel, transportation, medical care, things like that. Now, if we look at the 12-month change in the American CPI, it's risen 5% in the past 12 months. Now, that is the steepest rise in consumer prices since July 2008, during the time of the global financial crisis. And honestly, it makes sense. We've already been hearing about this in the media. It's now just the Federal Reserve is having to talk about it too, and because they're the ones that pull the levers, now everybody is listening. For example, one of America's most important companies is Berkshire Hathaway, led by Warren Buffett, of course. They own and operate many, many businesses throughout America under that Berkshire Hathaway name. And this was Warren Buffett warning us early last month that this stuff was definitely happening.
We're seeing very substantial inflation. It's very interesting. I mean, we're raising prices. People are raising prices to us, and it's being accepted. Take home building. I mean, the cost of, we've got 9 home builders, and in addition to our manufactured housing thing, and then operation, which is the largest in the country. So we really do a lot of housing. The costs are just up. Steel costs, just every day, they're going up. But there's more inflation going on than, quite a bit more inflation going on than people would have anticipated just 6 months ago or thereabouts.
Michael Burry also warned of the great American inflation story that's just around the corner before he went dark on Twitter and deleted all of his posts. People are warning us. And now even the Fed is acknowledging that inflation's getting outside the bounds of where they normally like to see it. So lastly, I wanted to touch on, why does this even matter for us as investors? Why do we care that inflation is rising? Well, as I said before, the way the central bank slows down inflation is by raising interest rates, putting the brakes on the economy. Now, at a big money level, raising rates means that new risk-free bonds become more enticing. And as interest rates rise, more and more money flows out of stocks and into bonds. What we've been seeing over the past few years is just the exact opposite. As interest rates fall, now bonds really aren't providing much of a return at all, so money flows into stocks instead. It's kind of like a self-fulfilling prophecy in a weird way, because all of that money flowing into stocks pushes the market up higher. But flip the story, and if rates rise, then money flows out of stocks and prices come down. And obviously that's not what investors want. So that's one part of the story. But then the second factor is that interest rates determine how cheap or expensive it is to access borrowed money. In a low interest rate environment, borrowed money is very easy to access. This means consumers have more money to spend on stuff that is made by the businesses we invest in. But it also means that businesses can fund growth opportunities without too much stress when it comes to their interest payments. So it's a good time for business to flourish. But then on the other hand, if inflation rises and interest rates are hiked up, then all of a sudden borrowed money is more expensive to access. That means that more of the consumer's income goes to debt repayments through things like credit cards, mortgages, etc. And that leaves less money left over for discretionary spending. And then for businesses, those big growth plans are now also harder to fund because they come with a larger interest expense. So overall, that is why investors are paying very close attention to inflation and are also keeping a very close eye on what the Federal Reserve is saying and doing from meeting to meeting. It's kind of funny that, even though the news basically says from meeting to meeting, interest rates stay the same, everything's just remains unchanged. It's still like headline news, front page news. But anyway, guys, that will do us for this video. I hope you enjoyed it. I hope you got something out of it. I hope it taught you something. If you found it useful or if you enjoyed it, leave a like on the video. And if you made it this far through the video and you want to see similar videos to this talking about the stock market, then make sure you subscribe to the channel. Of course, completely free to do so. It's the easiest way to support the channel, leaving a like and subscribing. So I really appreciate it. And if you're interested in how I go about my investing, then you can check out PROFITFUL. That's my business that I started up last year. We've got 2 in-depth investing courses there for passive investing and active investing. That's there if you're interested in learning more. But that will do me for today, guys. Thank you very much for watching, and I'll see you all in the next video. Hey guys, thanks very much for watching the video. So every now and again, people will reach out to me and ask what stockbroker I use for the trading or the investing that I do over in the United States. And for that, the brokerage site that I use is Stake. Now, Stake has been a long-term sponsor of this channel, and the reason for that is because I really believe in their platform. So what they offer is they offer a brokerage-free trading platform. So you can buy and sell stocks, US listed stocks, brokerage-free. Now, typically, if you went through, say, ComSec, what you would have to pay is you would have to pay, first of all, a foreign exchange fee, and then you would also have to pay international brokerage fees. Ends up being very expensive. So Stake still do charge the foreign exchange fee, but once your Australian dollars have been converted over to US dollars, then beyond that, the trading is free. So Stake is the one that I use. I really do like their platform. And of course, the reason that I like partnering with them is they give you guys a really good deal. So if you sign up to Stake using the referral code AWC, wow, that's going back. That's back to Aussie Wealth Creation days, if you remember. So if you sign up using the code AWC and fund your account, you're going to be given 1 free stock. So hey, pretty good bonus. It's better than a poke in the eye. So if you'd like to check that out, check out the links down in the description. Thanks to Stake, as always, for helping make this channel financially viable for me and sponsoring this content. And thanks to you guys for watching. I'll see you guys in the next video.